All right, we will be beginning shortly. You are in the right place for the Socially Responsible Investing webinar. I'm Bill Holliday. We will begin in about 1:20. This presentation should take about 40 minutes, but feel free to ask questions as we go. So if you have any questions, you want me to go slower or faster during any section, feel free to write in your chat box. And actually, if you could test your chat box, your chatting service, and just type in your name and where you're from, it'll just make sure we're communicating. It looks like I got a few responses there. Again, we will be starting in about 30 seconds. If you are able, it's best if you don't multitask. If you actually dedicate some time to this, you'll get the most out of it. So if you could turn off any distractions that might keep you from getting what you can. We'll go quickly through this. A lot of the material I'll go over will be covered, or is covered in the ebook that you'll be getting at the end of this. All right. Okay, well, let's get into the content. If people join us while we're going, that's fine. Not a problem. But I do want to respect people's time, those that have shown up on time. So let's start. The purpose of this talk is to describe how to participate in socially responsible investing, to make changes through your investments, and to get returns without sacrificing, to make changes without sacrificing return. This is what we're going to cover. We're going to go through definition of SRI. We're going to go through sort of the why, the how, and with what tools. So we'll look at the strategies that are implemented with SRI. We'll look at some of these investment options and how you can participate. And just overall portfolio construction. As a gift for sticking with us, we are giving out a new updated version of our ebook, and it does have a section about structured products, which I know is a popular issue. So if you hang out till the end, I will guide you to a page where you can download the free ebook. So let's get into what is SRI, Socially Responsible Investing, or SRI. It is a way to use the financial system to change society, incorporating your values into your investment decisions. You can hear of it. There's a lot of different words that or phrases that refer to the same thing. Sustainable. ESG is environmental, social, governance investing. Double bottom line. There is even faith investing is one of the areas that it can be referred to as. Let me tell you a little bit about myself. I'm a certified financial planner with AIO Financial. We're fee-only planners, and I do host a podcast. If you're interested in this topic, as information comes up, check out the podcast. I did first get exposed to socially responsible investing with microcredit when I was in Nicaragua in the Peace Corps. And then I helped found a microcredit organization that works on the border, the US-Mexican border in Mexico. And the firm, my firm here, we specialize in socially responsible investing. So why do people engage in SRI, and why has it gotten so popular? I think some of it is frustration with government's inaction, their issues, their inability to act on issues, and just looking for a different way to make influence. You can impact companies directly through SRI. And a lot of the the frustration too is that companies that donate a lot or spend a lot on lobbying pay very little taxes. There was a case where GE was spending $40 million on lobbyists and they paid no taxes. It turns out to be a good investment for company lobbying government, but it's frustrating because they're shortcutting the system. And so this is a way to get changes. People interested in specific issues such as climate change, if there is a carbon bubble, those, I guess, 2/3 of the oil reserves would have to remain underground if we want the world to maintain some of the targets, the threshold targets for carbon emissions. If those reserves stay underground, that is going to be a big hit for the market, the fossil fuel industry. And so some people want to avoid that industry for financial reasons and for, and for trying to make an impact on an issue. There are a lot of issues that you can impact through socially responsible investing. And some people, for faith, religious reasons, want to invest in a certain way. So SRI is growing faster than other traditional investment types. 1 out of every $6 is invested in SRI. The investments are about $8 trillion in funds that are, or funds or investments that do address environmental, social governance issues. You can see the growth. Part of it is because, and there's about 1,000 funds now you can see, but the growth is about $8 trillion currently in these types of funds. Part of it is there's more availability. There's a larger variety of types of ways to engage. Performance has gotten better because of the competitiveness, and just with time, there's more opportunities. And there's more information, I think, publicly available, so people are more engaged about company performances and certain issues. And some people do want to just avoid some of these companies. These are companies that if you hold an S&P 500 index portfolio or index fund, you're holding these companies. And if some of them you'd either like to make an influence on them or you'd like to avoid them, that's where SRI would get involved. Generally, we see 3 types of investors. Investors that want some engagement. They'd like to have, generally with community investing, large US company involvement. Some who want exclusive SRI, 100% of their portfolio. And then we find people who want a general index portfolio and just want to substitute in to address a certain issue. And again, SRI is different for different people. The 3 major methods or strategies for SRI are screening, shareholder advocacy, and community investing. And let me just briefly say screening is positive or negative filters in selecting investments, including or avoiding. Shareholder advocacy is just getting involved as a shareholder through your right as a shareholder to influence companies. And then community investing is providing money, financial services to people who otherwise, or companies who otherwise might not have access, to help partially with the wealth disparity, and some of it can be just for allowing companies to have access to capital. So I'm going to hit each of those 3 strategies. For screening, the excluding, you can just restrict. There are funds that pick the best of the worst. They don't necessarily completely exclude an industry, but they do pick some, and then they want to, like industry, I guess I put as an example, they pick the best they can find, and then they do want to make a difference, so they're involved with engaging with the company. And then, of course, there's positive, including companies. And I guess with this energy example, you might exclude all from oil. You might just pick the best of the worst, best of the oil industry or fossil fuel industries. And you might include alternative energies. So industries based on countries. Screening can be based on corporate social responsibility, what their practices are. And it can also be based on their policies and practices, their supply chain. Shareholder advocacy, there's several ways to get involved with a company. Voting proxies, so there are initiatives at shareholder meetings that you get to vote on whether you want those to go through or not as a shareholder. Letters to engage the company. Filing resolutions for shareholder meeting resolutions. In these resolutions, many don't vote. So you can pass a resolution with very little support. 30% a lot of times will pass a resolution. In-person meetings and dialogues, or to completely divest. If you can't engage with the company, if they're not following or moving in any positive direction, you can completely divest. Or a lot of times, if they're in an industry where there's just not much improvement possible, they're in the handgun industry and you're not interested in supporting that, there might not be much you can do since that's their primary product, and divesting might make the most sense. This is an important point. If you do not vote your proxies, if you do not vote for or against those resolutions, management just votes for you. I mean, it's a default that you're just going along with whatever's proposed. Non-SRI funds. So if you get a Vanguard fund or a iShares or an index fund or Fidelity, if it's not an SRI fund, they don't vote on these issues, environmental, social governance issues. And SRI funds they'll vote on your behalf, they'll file resolutions, they'll engage in dialogue. So it's important to pick a fund that's in line with your values so that you have them participating on your behalf. And how can you participate? Individual stocks and do it yourself? Or if you have a manager helping with individual stocks, they can do it on your behalf, or through funds, SRI mutual funds that are participating. Here are some of the leading shareholder resolutions, political contributions, and this doesn't mean saying you have to support a certain candidate. It's more just disclosure. What are you doing with political contributions? Climate change, again, disclosing what is your impact, what kind of impact your products are having, and making some positive changes there. Equal employment, adopting policies that prohibit discrimination or harassment based on sexual orientation is the primary currently that's being addressed there with equal employment. Let me just touch on the third issue. So there's screening, shareholder advocacy, and community investing. So this is helping people help themselves, and they call this impact investing or value investing. So the structures, how to get involved. It can be through community development banks or credit unions, and there's a list of classified or that are certified community development who have gone through that process. Now, some people just like credit unions because they're member-owned as opposed to shareholder-owned, profit-driven. They're member-owned. Members are their primary goal for credit unions. So even if they haven't gone through the certification of becoming a community development financial institution, doesn't mean they're a bad choice or that they're not doing positive things for their community. There are loan funds that are gathering capital. Usually they'll pay out at the end of a year, or it's restrictive how you can get access. So they don't have credit cards and checks like a bank or credit union would. community development, venture capital funds, and then microenterprise you can lend to as well. So the general approaches, and I'll hit these all a little more. The general approaches for socially responsible investing are through the SRI mutual funds, exchange rate funds, and it's a minor difference between mutual funds and exchange traded funds. The mutual funds are actively screened, whereas the exchange traded funds or ETFs are following an index. It allows them to have their costs lower, but they're not actively screening. I guess that's a big difference. The expense ratios are generally lower, the expense is lower. Individual stocks, and that can be on your own or separately managed. Community investment notes, credit unions, and alternative investments. These are the main tools or vehicles to get involved with the screening, shareholder advocacy, and community investing, building a portfolio of these different tools. Structured products, especially if you already have structured products, there are ways to get involved with structured products that have an SRI tilt to them. So let's just talk about mutual funds, exchange trade funds. The biggest question I get is, how does return compare? And I'm showing here on this graph the blue line, which is actually the bottom line in most cases, is the S&P 500, large US, and I'm comparing it to 3 SRI funds, and they are large US funds. So it's apples and apples comparison, and you can see this is a 5-year window. You can see it tracks very closely these different funds to the S&P 500. There isn't a lot of divergence, and if there is, it's mostly on the positive side for the SRI fund. So they are performing as well or better. And there's a lot of papers tracking the performance. They're not all equal. It's worth screening and looking at them. There's 1,000 choices. They're not all performing better than the index or with the index, but there are funds that you can get that are not without sacrificing returns. Some of this in general, when oil does poorly or fossil fuels do poorly, SRI funds will tend to outperform because they're going to be light or excluding fossil fuels. And then when fossil fuels are doing very well, you'll get the reverse. Defense companies, there's a few areas where SRI funds are going to be light or not have anything, tobacco, weapons, in general. Now there's some fund their focus is more religious based or a different screening, and then they might not be screening for those, but in general, when those industries are doing very well in comparison, you could underperform. When those industries aren't doing as well, like this, if there's issues with carbon bubble or restrictions or carbon tax, you'll see them do a lot better. Here's some a look at shareholder advocacy. Not all funds are participating in shareholder advocacy equally or at all. So Vanguard has a socially responsible social index, and it does not participate in shareholder advocacy. They don't do proxy voting on environmental social governance issues. They do not have staff working on this shareholder advocacy, and they're not putting resolutions forth. There are funds that don't have active staff, sort of a mid-range, and they don't put resolutions forth, but they are engaging with companies. And then there are funds that are very active. They have staff dedicated to making changes within companies. They are filing resolutions at shareholder meetings to make changes. They're engaging. And you can see it is reflected somewhat in the expense ratio. The more involvement, the more it is going to cost or come out of proceeds. Now, the funds would argue that the more engaged they are and the more screening they do, that's actually going to positively be reflected in their returns, that they're being very active with their screening. They're trying to make positive changes with the companies. And that is a positive screen. And you'll see during different time frames that does bear out. In general, what we recommend is go with the lowest expense ratio, all things being even. But if you do want to make an impact on companies, it's worth looking at some of these that are more engaged and comparing, again, screening, looking at performance. There are some that are performing just as well or better than a broad index. So those are, valid points that doing extra or very good screening, being involved, does help returns in the long run. Not only here's a look at returns for large US companies. Here's just an index, the Russell 1000 large US companies, annual return, 5-year return. And you can see the index with a low expense ratio doing quite well. Performance, yeah. And I guess this is a point with performance. This is, if you think fossil fuels are a bad investment, that there could be a carbon bubble, if you think diversified companies with reasonable, or diversified companies that are diversified in their board and in their workforce with reasonable executive compensation make for better companies. If you think poor supply chain workers' rights will make for poor investments, then SRI screening, in the long run, could be a better investment. So we're looking at past performance, but going forward, that's something to consider. Vanguard, okay. And then here's some, the Calvert, the Parnassus. Expense ratio is a little higher, but they're keeping up with the index. Green Century, same thing. They are staying with the broader index, even though their expense ratios are higher. Not only are these funds available in large US funds, but they're also available in mid-size international. So this is a mid-size index. They're available in small cap, small companies. Parnassus, keeping up with the benchmark. International Domini, keeping up, and actually in both cases outperforming the benchmark. There are bond funds. You can get a broad, diversified portfolio without, with SRI funds. Bonds, of course, they're not going to be involved in shareholder advocacy. It's going to be more just screening and dialogue with the companies that they're investing with. But you can see the short duration fund compared to the index bond fund, very competitive returns. The intermediate range, just an aggregate bond fund versus the Calvert bond, competitive returns. So let's look at a couple of these individual bond funds. And again, let me know if you have any questions, just put them in the chat column and I'll address them. So as we mentioned, Vanguard, low expense ratio. They don't get involved in shareholder advocacy. They have mostly large companies, a little bit in mid. They are following just an index, this FTSE for good index. The screening does contain social and environmental criteria, and they're following the principles for responsible investing. They're very light in energy compared to just a broad index. Parnassus, a little bit more involvement. They're a little bit more, quite a bit more stringent on their screening, their environmental screening, their social screening, and their governance screening. A bit more involved. And you'll see in the list of companies that they hold, it'll be a little bit more, aggressively screened. Products that they avoid: tobacco, alcohol, gambling, weapons, nuclear. And just to make a point, funds are not customized for each investor. So you might have no problems with nuclear or with alcohol or with gambling. I mean, some of these issues you might not care about, but they're not customizing a fund for each person's custom needs, because the larger they can keep these funds, the lower their expenses. They're trying to grow and compete with these large indexes that have a very low expense because they have huge investment pool. So there's sort of general screenings that you'll find, and that's where we are right now. I mean, there's a lot of funds available. You can get them specific, but if you really have one issue, it may be better to go through individual stocks, depending on the size of your portfolio. Portfolio 21, just as another example, they are very involved with shareholder advocacy. They're completely fossil fuel free. They're a blend between U.S. and developed foreign stock. They're environmental, social governance, and product screening. So the products produced by the companies and the responsibility of the companies. Environmental factors are taken into account as well. And it is a global fund. So here's some examples of funds. There are religious funds for different religions, of course. Islamic, I believe they don't have interest, they don't earn interest, don't have pork or I believe meat products at all in the portfolio. Christian, Baptist, different faith funds, you can find a targeted fund if that's what's driving your desire to be an SRI. Alternative energy, there's quite a few. Sort of broad funds, small size companies. There are specific technologies, wind, solar. There are global and domestic type funds as well. Other targeted areas, women's workplace, water fund. There are international and small. Now, for developing or designing a portfolio with individual stocks, the advantage of that is there's no expense ratio. You're not paying a management company to manage it. So that 1% or 0.5% or less or a little more, you're not paying that with individual stocks. And you can custom design it for your issues. So if you have no problem with whatever it is, you can include those stocks. Or if you do have issues with some of the companies that are included, you can be more stringent. You can vote the proxies yourself. You can engage as you want. There are groups that you can get involved with to move issues you're interested in. There are shareholder resolutions that you could help support. The disadvantage, though, is there's time to do all that. That's kind of the advantage-disadvantage right there. To get involved with companies, there's some effort. It hasn't ever been easier than it is now. You can see what Sierra Club recommends for different shareholder resolutions. So it can be as much work or as little work as you want. Generally, the SRI funds are going to be pretty engaged. They have a lot of influence because of their size. So that would be an argument for the funds. There is also, with individual stocks, you do pay a transaction fee for buying and selling. It's usually around $8 per trade. And if you're rebalancing regularly, buying and selling to keep in balance, your portfolio in balance, or if you're adding regularly, it can add up to a portion of your portfolio. You might be spending a year, a percentage of the portfolio that, again, unless it's a large portfolio, could justify using a fund where there are no transaction fees. Well, depending on where it's purchased or if you're going through a commission broker or not, but there wouldn't be a fee if you're doing it on your own. So we generally say if you're investing more than $1 million, individual stocks make a lot of sense, depending on the amount of engagement you want to have. So it could be a blend of funds and stocks. But smaller portfolios, it's hard to justify it. Unless there's an issue that you really want to have individual investments for, individual stocks for. So community investing, here's some examples of these community development banks and credit unions that you can open online accounts no matter where you are. And they are focused on providing their loans to the community, to people who otherwise might not have access. But again, credit unions in general, as member-owned entities, are not a bad option either, especially if you want a presence in your community, if you want some place where you can physically go. Microenterprise loans, you can just invest directly with a microcredit organization, or you can lend to a pooled investment fund. So you can, Calvert Fund, for example, you'd be lending to them or getting a note from them, and they'd in turn lend it out to, between hundreds of different microenterprise organizations. The advantage of the pooled community investment is there's a little bit more protection. They're doing the screening. They're requiring certain loan loss reserves. It is fun to be directly investing in a microcredit organization because you can go visit them and see who's being impacted. You're getting material or information right from the organization you're supporting, and you can be more engaged. But for protection, the pooled community investments could make sense. Axion's another option there. Just briefly, I am on the board and have been involved with a microcredit organization on the US-Mexico border in Mexico. And just to briefly describe how they operate, people form groups of 10 to 15. They get loans. There's no collateral, but everyone in the group has to pay their loan, or you have to support other people in the group. Otherwise, they won't get a subsequent loan of a larger amount. We generally have, and generally you'll see this in microfinance organizations, more emphasis towards women, whether it's that's by design, or in our case, that's just because of our methodology. You have to meet every 2 weeks because you have to support others because the loan sizes are small. That's just how the community we're supporting, the communities, how that's worked out. It's also a convenient way for women with children to be able to work without going outside their home. Very small default, and you'll see that throughout the microcredit community. Here's just a few pictures from the operation there. So returns on investments, here's as an example, just a Schwab money market or CD. Compared to the credit unions, very competitive. Compared to the community notes, very competitive. Compared to lending directly to an organization, you'll be getting more return. Again, there is more risk, so it's not fair to compare this to the same. These aren't of the same quality. This would be more of a lower mid-quality bond fund. Other community investments, RSF, social finance, and they are loaning to schools, to different organizations throughout the US is where they focus. There's a bunch that are trying to help with the foreclosure situation to structure loans, and they pay you back in interest, but you're helping to keep people in their homes. This one, of course, is working in Boston, but there are throughout the country loan funds. Alternative investments. The advantage of alternative investments is they're not moving with the market. They're not going up and down with the market or getting impacted by interest rates. Right now, bond funds are a tough investment in this environment where interest rates are moving up, where rates are currently very low. So this gives you another way to invest. They give good returns. We usually see 6 to 8% returns. The disadvantage is they're illiquid. So you invest, the general cycle is you invest, they're raising capital for a couple years, they're running their operation, getting a history for a couple years, and then they're looking for a liquidation event. So it could be a 6-year, it could be longer, but it's a longer term investment. And there's not a big secondary market. So really you're investing until there's a liquidation event and you get your money out. And just a side note, alternative investments, and I'll go through a few examples. They can seem really appealing. Just be careful how you're getting them. Either get them by yourself or go through a fee-only advisor who's disclosing their fees. We've seen commissions of 7%, 4%, annually 4% and up. And it's coming right from your profits or your returns. So just be careful how you're doing it. The examples I'm going to talk about: Greenbacker, TriLink, Iroquois Valley, and SQN. There's lots out there. These are some of the ones currently that we've liked. And these aren't appropriate for everyone. There are sometimes screenings so that you need to be either an accredited or semi-accredited investor even to get involved. What Greenbacker does is they buy clean energy plants. They sell that energy in 20 to 30-year agreements to municipalities, to utilities, to different companies, and they're paying a decent interest right now. And then when they go public, whether they turn into a mutual fund or sell it to a fund, that will, they're expecting that should generate a boost as well. TriLink, they're a global bank. They're working in emerging markets for mid-sized companies. Similar investment length as I was discussing. They're all collateralized loans done in US dollars. And they're paying an decent annual interest. And again, what's nice is these aren't flying up and down with the stock market. You just get your annual payment, and when there's a liquidation event, generally you get another boost. Iroquois Valley Farms, organic farming, they're buying up farms and converting them. It's a pretty long-term investment, and you have to be an accredited investor. You're not going to get payments until they liquidate, and it could be a long period of time. They are saying that they are having a good return, but you're not going to see that until they actually make this public. SQN, they buy business critical equipment, they rent it, and then sell it. You get paid out as they sell the equipment. So generally it's a 5-year lease, and then they'll extend the lease or sell the equipment, but within 7 years, you're getting your money out. And currently it's paying pretty well. And they do focus on some nice areas. One other way, so we've talked about mutual funds, exchange rate funds, the community investment notes, credit unions, alternative investments, and then structured products are another area. And they come in two types: market-linked CDs and buffered notes. A market-linked CD, very straightforward. It's an FDIC-insured CD. At maturity, it's linked. Instead of paying you interest, they're paying return on some index. At maturity, if that index is up, you get the gain. If the index is down, you get your money back. FDIC-insured. Buffered notes come in a large variety. You can do an individual stock. You can link it to Apple or Google or Facebook. They have some downside protection, but not 100% downside protection. This example, generally it's 10 to 15% currently. As interest rates move up, it'll protect more of the downside. What's nice about buffer notes is that they are shorter duration. Right now, they're generally about 2-year duration, which is less than the market-linked CDs. And then they generally give you an upside enhancement. Currently, they're doubling your money on the upside up to a cap. So if you were to invest, well, let's just talk about an example, Apple stock. They'll give you a 15% downside. It's a 2-year investment, 15% downside, 1.5 times the upside to a cap of 30. Now, within the general standard deviation of returns of Apple, you're 2/3 of the time, you're most likely going to be 100% protected on the downside, and you're going to be doubling your upside within that 2/3 of the time window, you're pretty well protected. But a third of the time, actually, it's going to be less than that on the upside. But so a sixth on the upside, a sixth on the downside. But since we're 2 standard deviations up, it's really going to be a 1/12 of the time on the upside. You might hit a cap and underperform. So it might do more than 30% in the next 2 years. And then you'd be missing out on some gains. That would be a disadvantage. On the downside, there's about a 1/6 of the time, it may run lower, that in 2 years, it may have losses more than your protection, but you're still going to outperform if you just held Apple stock. So if it went down 20%, you'd lose 5%. If it went down 30%, you'd lose 15%, but it's a lot less of a loss than if you just held it without any protection. So constructions of portfolios really depend on your time horizon. When do you need that money? If you need it in the next year, you're not going to get involved with structured products or alternative investments or stocks. If you don't need it for 20 years, then you have a little bit more flexibility, and your tolerance for risk will drive the types of investments, how much you want in the different types of investments. If you're very tolerant for the volatility, or if it gets you upset, or if you don't want to see losses or significant losses, then that'll help drive how you develop your portfolio. And then there is a SRI questionnaire. It's in the ebook that you get with this webinar. And that'll help drive the types of investments. Do you want a lot of shareholder advocacy? Do you want just indexes? Do you want what kind of involvement do you want to see? And this is, I apologize, it's pretty small, but this is a look at some of the investment types, or an example portfolio. And these are all in the ebook that you have. So looking at low risk, short time frame, intermediate risk, intermediate time frame, long time frame, and a high tolerance for risk. The shorter your time frame, the more you're going to be in more fixed investments. The less volatility you want to see, the more in fixed investments, the less in stocks. And this is an example of a fossil fuel free portfolio. So we're looking at funds that are fossil fuel free. We're looking at investments that don't have anything in there about fossil fuels. Even in the alternative investment, we picked out one that was in renewable energies. Even though the other ones aren't invested in fossil fuels, we're picking a positive screen on the alternative energy side, on the energy area. So this is, again, every person is different. So some of these might not be appropriate, of course, but these are examples of portfolios that would give you a fossil fuel free portfolio with different risk tolerances. And here's just a broad SRI portfolio, not picking solely fossil fuel free, but some of these funds are trying to make influences in natural gas, not holding necessarily oil companies, but having some in the fossil fuel industry. They don't exclusively screen, but they're trying to make positive impacts. Similar, if you're in low risk or short time frame, you're going to want more secure, more stability. If you're high risk or you have a long time frame, then you can take more chances into the market. Final thoughts. There's many options out there. You don't have to sacrifice returns. That's a big point I want to make. And you can make impact through a number of different ways. So if you have an issue like poverty reduction, microfinance would be a good fit. If corporate responsibility is important to you, then some of these SRI investments make a lot of sense. And again, you're not sacrificing return. So that's just so that you know if you need support with this. If you can do this on your own, go to it. That's great. If you need support, I mean, we really just want to encourage people to get involved. But if you do need support, please let us know. We are fee-only advisors. We do not get commissions. We do not sell products. We are compensated only by our clients. We only look out for our clients. We're independent. And there's a lot of ways we can work with people. We can do hourly work if you just want us to check what you're doing. We can manage assets if that's what you want. We can do individual stocks if that's what you want. We can help in a number of ways. So we're also comprehensive advisors. So in addition to asset management, we do look at retirement planning. I'm actually doing a podcast or a webinar about retirement planning. We do help with taxes, insurance. We don't sell insurance at all, but we do review what you have, discuss what your needs are. Same with estate planning. We don't do the estate planning documents, but we can see where you're at, see what you have, and support if needed. So if you want a meeting, we offer a free upfront meeting. You can go to our site and schedule a meeting. So that's it for me. Please, if you have any questions, just type them in the chat there. We do often get asked what resources are available, so let me put that in. One resource that's available is our ebook that you're getting. SRI ebook. Another site that's useful is ussif.com. And social funds is a good one. Also, our podcast is useful. Okay. Our podcast may be useful for you. Okay, link for free. Okay, let me know if you have any other questions. I'll give it a couple minutes, and then I think I will put this into I'll send you to our site. But yeah, let us know if social funds, and then AIO Financial. We do have a podcast and blog. And we actually have a site, Socially Responsible Investing Hub. It has the same information. AIO Financial, we also address other financial issues and investment issues, which we don't post to the SRI fund. And room, here we go. And I'm going to send you off to our site. All right, great. Okay. All right, that's it. Thank you very much for attending, and let me know if you have any questions. Thanks. Oh, yeah, I should have started sharing. Sorry about that.